Welcome to a fun one today, guys. Happy Monday. We got Jeremy from Calque. Check out Calque. This is brought to you by them. But more importantly, I'm in here, Jeremy, because I want to learn, man. Like, we don't usually get to talk to people in the industry about where we're at and why we're here. And I love that because it tells us, if we pay attention, it also tells us where we're going.
Yeah, I think that's right, Tristan. And hopefully some of the data here will give a little bit of historical background, but also some tools for exactly that, trying to think about how to react when things change and where we're headed.
Perfect, man. Appreciate that. Now, before we start, because I've got the deck that you uploaded, tell me really quick, what is Calque and what does it do?
So we provide guaranteed backup agreements for lenders that allow the lenders to eliminate the departing residents from debt to income so the homeowner can close on the arriving residents without a home sale contingency.
Oh, so you make it easier for somebody who wants to buy a home that's an owner. So
That's
they can
right.
actually buy the home without having to sell it.
Exactly. That's right. I'd say this is the most cost-effective evolution to date of the buy before you sell, programs that kind of gained a lot of traction over the last few years. And
Perfect,
it's just a lot more cost-effective because we work with established lenders.
I like it. Thank you for that. All right. By the numbers, the impact of rates on home purchase volume. I mean, does it all come down to the rates, to the mortgage rates, Jeremy?
Well, so according to the historical academic studies, about 0.2 to 0.4, an R squared of 0.2 to 0.4, or roughly, my stats professors are going to kill me for oversimplifying, but roughly 20% to 40% of the volume that we see can be explained by rates. And you can tighten up those models a little bit. And I've got a slide here that covers it. When you control for some of the other key variables, home prices, et cetera, that obviously plays a big factor as well. And then really robust models can have R squared of 0.6 to 0.85. So a really robust model can explain about 60 to 85% in a very accurate prediction of what changes about home sale volumes. And so, rates are pretty meaningful when you're looking at a single variable like that, and you're talking economics or anything that involves human behavior. An R squared above 0.3 is pretty strong.
Got it. All right. Let me just say hi to a few people on here. By the way, if you're not in the chat, let us know what city, what state you're watching from. If you're on social, YouTube, Facebook, or in the webinar, I see some of you that I know: Tony Gonzalez, Lindsay LaFawn, Amy Izzo. What the heck, Amy? Nice to see you here. David, Craig. Nice to see everybody. All right, Jeremy, where do you want to start? And do you want me to move the slides, or you got it?
If I can move the slides, we'll just move the slides. All right, here we go. So I think everybody knows that home buyers have felt this way for about 5-6 years at this point, right? They've looked at the housing market. It's been absolutely nuts. And it was a seller's market from 2020 through 2022, 2023, and then it moved into a more balanced environment. And now we're really starting to move more towards the buyer's market at this point. But part of what keeps it from being a true buyer's market is that while home buyers kind of reacted like this for the first part of it, right now, home sellers are kind of reacting like this, right?
Oh, wait, but dude, that's all. That always happens.
It does, but it's at I think it's at an all-time high at this point. It's not unusual. I had a conversation with a home seller Thursday, and they bought the house 2 years ago, and they think it's worth 10% more than when they bought it 2 years ago, despite the fact that.
Are they in Florida or Texas? Because it's going the wrong way. Oh,
yeah. Really? Well, so their market has declined about 3 or 4%, and they think it's gone up about 10. Right. so
that's terrible. Sorry, man.
It's a pretty meaningful disconnect, and that difference between buyer expectations, which are they're at a point now where they are starting to have more influence in the market. But sellers, especially sellers who did buy at that peak
Yes.
2-3 years ago, right? The funny thing is the sellers that did buy at that peak, one, they feel they are financially, more exposed because they bought at the peak
100%.
and they bought when rates were high. But then on top of that, because they kind of bought into that frenzy, there's a real tendency for buyers to have really profound buyer's remorse, and for that to, I would definitely say anecdotally, the people who bought 2022 to 2023 are usually the ones that have the biggest disconnect in expectations, partially because they have a higher place to come down from, partially because they really did buy into all that momentum right at the time of hey, rates may be high, but home prices are just going to keep going up, right?
We don't talk enough about that group of people who purchased during that time, because they're upside down in a lot of, and I'm generalizing in, but a lot of those states that were moved into during the pandemic, they're upside down.
That's
and
right.
they could ruin those markets fast if they have to step out quickly.
That's exactly right. And some of that resetting is exactly what, you pointed out. Texas and Florida, those are two of the markets that had, some of the hottest response in 2020 to 2022 and some of the fastest appreciation. And those markets are coming down. Not every market in those states, but by and large, those states have been under more pressure. I live in another one that's under some pressure right now, which is Denver.
Oh yes, dude, you do. That's so true. I'm watching. All of a sudden, it's like Colorado. What's going on?
Yeah, I mean, it's a pretty meaningful difference in where things were 2 or 3 years ago, and it can take a real adjustment for sellers to kind of come to grips with it. And so this is just a real simple graph, courtesy of Mortgage News Daily. It's looking at existing home sales by month. And then this is showing and kind of mapping against the 30-year mortgage rate. And so you can see that it's not a perfect correlation, right? But you can see kind of this dip in 2019 and 20, and as that dropped, you see these big spikes kind of coming up, and then you can see it spiking back up, and you can see home sales gradually coming down. So that's not what any of my professors would refer to as academically rigorous. Looking at a graph and go, well, it went up and then it went down. But academically rigorous studies, and we'll get into some of those in a little bit, have indeed found that there's a pretty strong correlation between rates and home prices, as well as rates and home sale volumes. So when rates go up, some of that gets given back in terms of prices as sellers start to meet concessions and move towards market equilibrium. Some of it gets given back in terms of volume, right? It is very much, if you think back to supply demand graphs in college, where they're going this way, and then you see a shock and a shift, and you see both a reduction down and a move to the left, right? You see a reduction in volume and a reduction in price. And that is what happens when rates rise. Now, it's not a perfect correlation. There's a lot of other things that factor into it. The biggest one long-term for the US is just a profound and persistent lack of supply. We don't have enough houses. And we definitely don't have enough houses in the markets where people want to buy houses. And we very definitely don't have enough of the types and sizes of houses that people want in the markets where they want them, right? So
do you take into consideration here with this the fact that in those markets where you have more inventory, you also have new construction causing a large part of that problem?
So I did have a whole other subsection on new construction, and I pulled it out of the deck in part because the amount of extra data around builder concessions is pretty spotty. And so I wasn't able, I could have included a lot that would have been kind of eyeballing the graphs like that last one, but I couldn't find enough academically rigorous studies that controlled for builder incentives in a way to feel to go ahead and include that. So I didn't go into a lot of detail there, but I did look at it. And you are right that there is, I'd say, again, not academically rigorous, but I'd say there's good anecdotal evidence that, you go through this period where there's this huge boom. Again, Texas and Florida are really good examples of this. You go through this period where there's this huge boom in buyers moving into an area, and that pushes up immediately pushes up demand. That immediately pushes up the price on existing home inventory. And on a more gradual basis, it pulls builders in, right? Builders respond more slowly and they start building out in that market. Well, then that boom goes away, prices start to come back to normal, and you have new home inventory that's already committed, right? That's already coming online from those builders. And so that is one of the places where normal, like the market is perfect thinking doesn't really apply as well when you're talking about long-lived assets, or when you're talking about slow to supply assets, which homes qualify as, right? So it's a lot tougher to build a home on an empty lot. That takes a lot more time than it does to, ship more oil someplace, right?
That's so true. There's always that challenge, man. And I think it's so hard to play into that longer term as a builder, right? It's like, hey, let's go build. Like, how do you decide you want to build in like the suburb of Dallas, but you won't be done until 5 to 7 years from now?
That's it. And you try to get by with economic forecasting models, right? But nobody builds a perfect economic forecast. And when you go through periods of time where you're trying to account for buyer preferences, that's really what that is. When you pick what types of home you build and where you build it, buyer preferences are notoriously difficult to predict over a long time frame. And then they're also really difficult to predict when you have essentially customizable or customized assets, right? Versus a commodity like wheat or oil or, some standard unit of product that's always the same. Houses aren't always the same.
Jeremy, on this one, on the affordability index that you're getting from Fred, where do you see this going based on what you're seeing happening?
So I do think affordability, up until 2 weeks ago when rates started bumping up again pretty high, I was seeing improvements, very slow improvements in affordability. And there's really two immediate factors that come into play, and one that takes more time. So the one immediate factor is, what are home prices, right? They can respond pretty quickly. Home prices, again, not as fast as a commodity, but home prices can move based on inventory, and they move over the time frame of a few months. And those trends may continue for years, but you can start to see those things shifting and happening within a period of months. The other is rates, which we know instantly, right? We know average mortgage rates on a daily basis, right? There's enough visibility and data, which is kind of a unique market to have that level of transparency. Those two things really affect how expensive it's going to be to buy a house. And then the other is, how much can somebody afford? That's a longer, more gradual response, which is really a function of wage inflation, right? Wages go up and you have more income available. You can afford more house.
Jeremy, where are you tracking wage inflation? Typically, where do you go and grab that information?
So you can get some wage inflation directly from the Fed. There's actually a pretty I would look at wage inflation versus CPI or most other inflation metrics when we talk about this, because so many other things can be carved out or included in and have their own kind of movement to it. And ultimately, it's wages that are going to determine whether or not somebody can qualify for a mortgage. And a lot of times that's going to be the determining factor for whether or not they can buy a house. that's what I'm looking at here. This is really this affordability index, oversimplifying slightly, is really looking at it and saying, all right, how much of the average household, median household income is necessary to buy the median home in the US, the median priced home in the US.
Perfect.
That's
And
really
also,
what this is looking at.
to answer a quick question, Marnie, when you're looking at this graph, I put up the link to the Fred Affordability Index too. It's just how they showcase it. The government's technology. Look, it's the government. It's a hit or miss. They cut it off. They can easily fix it with AI, but they refuse to, I guess. Just go to the link. You'll be like, oh, they can't put it into something that fits into a website. The answer is no, they can't.
You've got to run reports. That's right. So, as you can see, we've really, we've seen this number hovering, and on a historical basis, on a longer term basis, this is pretty elevated. This is pretty high. This is basically saying the median house needs 115% of their income to qualify. The median homeowner, the median household, needs 115% of their income to qualify for a median priced house in the US. So that's a lot of people who just can't afford it, even if everything, even if they bought the maximum house they could qualify for, they're still struggling.
I think that's the part that we miss. And this is why I wanted to have this conversation with you. And that's when we're looking at affordability as a whole, not only are mortgage rates extremely important, but the affordability index is also tracking other things like what does it take to live in general, right? And everything that it takes to live is increasing rapidly over the last year. And so when we take a look at those, it's like, wait a second, apples for apples, maybe rates aren't so bad. Maybe prices haven't gone up as much in comparison to inflation. But wait a second. What about insurance? What about food costs? What about everything else that we didn't have to worry about 30 years ago, right? All of a sudden, it's pricing us out. That's why I love this conversation.
Yeah. And prices have risen pretty rapidly, right? Especially in that 2020 to 2023 period, right? 22 in some markets, 23 in others. And then they pretty much flatlined since. And we see a lot of, there's a lot of variance across regions, both in the degree of spike and in the degree of decline. Some of that's going to start evening out. And I think we are going to see, there'll still be a lot of variance by state. There will be some markets that are still very, very hot. And homes are selling like hotcakes, and others where they're on the market for 8 months, and people are making big price concessions to move them. And so but it is beginning to even out. I think we have probably another year of pretty high variance, and then we'll start to see nationwide numbers look a lot more like the numbers in most regions.
Perfect.
And so again, I looked at a lot of academic studies. I read hundreds of pages of academic journals, so you don't have to.
Thank you.
And the correlation about 0.2 to 0.4 for rates alone, about 0.4 to 0.6 when controlling for basic variables like home prices, and about 0.6 to 0.85 with a full housing model, which is again pretty accurate when you're predicting how people behave, right? It's when you can explain 60 to 85% of a consumer's behavior with a model, that's reasonably accurate. But I want to decompose that and go into a little bit more detail about the different components that go into a model without a lot of scientific jargon around it, just trying to go into like, these are the real numbers that consumers experience and what happens as a result of rates and what's happening as a result of prices and what's happening as a result of wages. And so if we kind of look at those, at a more easy to understand framework, that's going to be something that's hopefully more useful for viewers to think about how this affects their day to day. And so if you look at a $400,000 balance, so forget about home prices for a minute, a $400,000 mortgage, forgetting about all those other things that you flagged, Tristan, forgetting about insurance, forgetting about food costs, forgetting about wages, just looking at the mortgage financing cost itself, no taxes. In 2020, with a rate of 3.15%, the monthly payment on a $400,000 mortgage, again, just P&I, would have been about $1,720. In 2023, with rates around 7, that would have been about $2,660, about $940 a month in increase just from financing cost. And then in 2025, with the average rates in 2025, you see that come down very, very slightly to about $110 a month. So still up about, $830 for the same amount of financing as in 2020. But then when you look at the median listing price over that time frame, that same 80% loan amount on the median listing price, an 80% loan amount in 2020 would have been about $237,000. 80% of the median listing in 2023 was up to about $335,000, and in 2025 fell to about $328,000. So the other big thing to think about is it's tougher to make these monthly payments, but then on top of that, they're having to bring more of a down payment to bear as well. And so that's eating into the cash reserves that they've got available. So if you're sitting here and you're like you said, you're struggling to make ends meet, you're worried about your job. Today, people are worried about the potential impact of AI on their job in a couple of years. Mm-hmm. All of those things start to factor in. And then you're going, well, I'm going to take $80,000 out of my bank account instead of $60,000, plop that down. And then on top of that, look at the change in the monthly payment from 2020 to 2023, the monthly payment in 3 years, when you include the actual amount borrowed and the impact of rate, just the change in principal and interest in that monthly payment more than doubled going from 2020 to 2023. So that's a pretty profound impact. And there's a little bit of relief now, $120 a month from the peak, but look at that. It's $2,100 versus $1,010. Even with some of the give back on rates, and even with the very slight reductions in home prices that we've seen over the last year, the median monthly payment for P&I on a median house in the US is about twice what it was 5 years ago.
That's crazy.
And so, you can look at this and you can see part of what's happening is home prices, again, due to that persistent lack of supply, home prices were elevated even before the pandemic. So this is the Case-Shiller Home Price Index. This one's unadjusted for inflation. So when you look at this home price index in major metros, and that's why it's different than the numbers I was showing earlier that do show a little bit of a decline, this is tied to really just major metros. But when you look at that data, you can see that, look at the peak in 2008 and look at where we were in 2020 prior to the pandemic.
Wow.
And then you can see what happened during the pandemic. So this is adjusted for inflation, and you can see that it's really been kind of like keeping steady.
That tells a more complete story, man. Like,
yeah.
We go back to the previous one, because look at that massive bump, but you don't see the big bump in 2008 as much unless you add inflation. It's so crazy.
That's right. And part of what happened here is because of the crisis, because of the Great Recession, builders stopped building unless they were sure that they were going to be able to sell the homes. So to your earlier point, how do you predict as a builder? How do you plan as a builder? In some cases, they planned by only building in markets where they were 100% sure there would be demand. And in other places, they just didn't build as many houses as they otherwise would have, because none of them wanted to be caught with their shorts down like they were in 2008, 2009. So that underlying supply shortage is what really pushed prices up from 2011 all the way up to 2020. Then you layer onto that an acute supply shortage because there wasn't enough lumber, because nobody built anything for 4 months, right? Like we went through, and then when they did start building, they were building in very cautious ways, right? So the pandemic further restricted supply. And that's what causes that huge spike that you're looking at in back part of 2020 and into 2021 and 2022.
Makes sense, buddy.
And so this is just a graph. This is just a graph I threw together. Those others are either Federal Reserve or I had notes so you can see where I was picking up the data. This is just from those calculations that I did that kind of show the affordability gap starting in 2020 and then trying to decompose the monthly payment factor from a principal and interest, and then also trying to look at and showcase wages as well. So you can see that there is a little bit of relief in wages here. This orange line, wages are up about 21% over that same period. But you're talking about 21% more income to cover 100% more monthly payment.
Dude,
right?
They didn't even keep up.
Did not even come close to keeping
Okay,
up.
so now here's something that I want you to explain to all of us, because sometimes we miss it. And this graph tells it really well. With your explanation, okay? You look at 2020 to 2021, end of 2021, you start seeing it pull apart. But the thing that we're not looking at here is the amount of money that was created in order for that separation to happen. And
That's right.
Here's what I'm fearing now, right? Obviously, we don't know what happens, but I'm fearing that we could be in a similar situation with all the amount of money that's being thrown into the United States right now. And it makes me feel like it's similar to that 2021 to 2023.
That's right. And part of that, for all the talk about what the Fed does, short of when the Fed changes the Fed funds rate, that has a relatively low correlation on longer term mortgage rates, right? In part because you have mortgage spreads, which may move differently than the Treasury. Like, we're actually really lucky right now that the difference between, and this was something I was predicting about a year ago, year and a half ago, I guess, is that mortgage spread would shrink. In other words, people would start to feel, and that's really about investors looking at it and going, well, do I trust the full faith and credit of the federal government? And how much more do I trust that than I trust a mortgage holder to repay their mortgage, right? That's really what that spread is. It's a credit difference. It's looking at it and going, okay, I can put my money here for 30 years, or I can put my money here for 10. Really, I can put my money here for 10 years. I can put my money here for 10 years. And so if you look at that and go, all right, I want to charge this much more because I trust the federal government more than I trust the average homeowner to pay back their mortgage. The difference in that has started to shrink. And so, that's not great for trust in how much money we're creating, which is part of what they're worried about. But it is some flight to safety in mortgages. But the other thing that really factors in here in a pretty meaningful way is, to your point, part of what happens, part of this spike from 2021 to 2023, a big chunk of it, again, is rates going up, right? So prices rose all along. But the reason it was subdued from 2020 to 2021 is prices were going up, but rates were falling, right? And so there's an offsetting factor. And then you see the two of them working together in tandem, kind of driving the next couple of years. Rates went up. And it's not just the Fed saying we want rates to be high. It's investors looking at it and saying, well, there's a lot of money flowing through the system. I've got to allow for some inflation. I got to charge a higher rate. I've got to charge a higher rate to help make up for the inflation that I think is coming.
Yep.
And that's really a big chunk of what gets priced in. And it's why it's not just, the Federal Reserve can't just wave a magic wand. They either have to buy those mortgages and put them on their balance sheet to artificially create demand for mortgages, which reduces the rate that people have to pay because you've already sucked some of that supply out of the system, right? And so, they have to be more. They have to rein inflation expectations in, and so that's a big part of their mandate is to that part of what they do is they try to keep an inflation mandate in part so that money will continue to flow into the system, so that people will continue to invest in these things without demanding really crazy rates because they think inflation is going to be so high and they've got to make up for it.
So where do you think we go next with what you're watching happening? Like, give me a couple of scenarios, because we don't know where we're going, but give me a couple of scenarios.
So obviously right now, the oil shock, the war, all of that is having a pretty big impact. We were looking at, gradually declining rates throughout the course of the year.
Yeah, which is awesome.
I was never expecting rates to get to 5 like some people were, but were we going to be at 5, 5 and call it?
Dude, I thought we would get to 5.5 average. Like we were trending. I was like,
yeah, my best guess for the year was about 5 3/4 for an average, rates between 5 and 6, starting at 6 and gradually trending down to 5 and, bumping a little bit throughout the year. Now we're back up getting closer to 6.5 already. So a lot of that boils down to, what happens if the war ends in a week and oil starts flowing safely. Do rates start to gradually move back down? Yeah. Are we looking at 5 3/4 again? Probably not. It's probably 6 1/4 for the year.
yeah.
If this thing goes on for another 6 months or a year and there's a profound oil shortage and energy prices skyrocket and investors start pricing in an expectation of higher inflation as a result of that energy crisis, then rates start to go back up. And that puts profound pressure on housing. We're not in the same level of underlying credit risk as we were in 2008. There aren't nearly as many ARMs. There's about a third the percentage of ARMs outstanding now as there were back then. So we don't have that huge reprice pressure, but there is some reprice pressure. And part of why prices are propped up right now, again, sellers have unreasonable expectations. And so those unreasonable expectations may turn in a hurry. And the very fact that there is all this equity built up, right? If you're a homeowner and you've been considering a sale for the last 3 years, but you've been hoping that rates are going to come down, and that reduction in rates is going to mean you get a better price for your house. So you've been sitting on it all this time. Now, all of a sudden, it doesn't look like those rates are going to come down. One, you have a point you made a post about the other day, Tristan, which is basically that life happens and life moves on. And, that lock-in effect will gradually start to ease as people start, yielding to the necessity of life. But then on top of that, the second that people start to worry that the longer they wait, the less their house is going to be worth, the more we may actually see concessions coming on. And that could trigger a crisis. So if this thing goes on and rates hit 7 and, people start getting frustrated and, it's a pretty high, it's a volatile environment right now. And normally I'm pretty comfortable making predictions, but that's a pretty big wild card on the table. And we just don't know where that's going to shake out. We're getting lots of assurances that it's going to get better, but at the same time, they're trying to borrow 200 billion more. So why are you borrowing 200 billion more if it's going to be over in a week? Right. It's a profound, disconnect in the messaging. And I think until we see how that resolves one way or the other, it's going to be real tough to predict anything.
So how do you suggest that we stay in front of this as real estate agents and just be better educated so that we can help our customer?
Yeah, I think there's a few things to do. One is if you're working as a listing agent, help your sellers be realistic about the fact that prices have been coming down. It's not a crisis. It's not a fire sale yet. But prices have been coming down, especially if they bought in 2022 to 2023. Like, they need to get realistic if they want to sell their property. And I think one of the things that we probably do need to do industry-wide as real estate agents and as lenders is, to your point, we need to be a little bit more judicious about promising a crystal ball of, hey, rates are going to drop, right? Rates are coming down. Rates are going to drop. like it's going to get better. That may help move the needle today, but being realistic is going to help, over the long run, help us all avoid a housing crash. So, just help people be realistic and move the inventory.
Are you telling me we shouldn't use the phrase date the rate? Is that what you're telling me?
We have some friends that use that phrase a lot, so I don't want to out them. I don't want to out them here, Jim.
I want to out him. Come on. What the hell is that stupid phrase? Don't use that phrase, everybody. Don't do it.
Tristan, I would say that that's a super popular phrase, and some of the smartest and best people I know have tried to give good guidance around it and have given good guidance around it. Like I said, we've got some good mutual friends that have said that in the past, but have also always been very judicious about how they talk about it and telling people we can't predict it, we can't be 100% sure. Be responsible. Yeah. So date responsibly, and I think that's where
that's a better phrase. Come on,
that's a better phrase, and I think
responsibly.
And I think not every lender has been as good about that as some of the ones that we know, right? They haven't been as responsible about that messaging. And I think that's the key thing in social media is, date responsibly, and have a backup plan. Have a backup plan. So, and it is probably, I would say, it is an unusual thing when we start to see stuff like ARMs. If a 5-year adjustable rate is priced higher than a long-term fixed rate, unless you're getting some real incentives for that, it's probably better to take the fixed rate, right? Like, the optionality is on your side. And that's the thing about dating. And I think that's where the intent of that phrase comes from is the intent of dating is to wait and see, and fixed rates help you do that. And so I would just say be careful of ARMs today. Be judicious.
I mean, look, be careful of ARMs back in the day, and even though the ARMs now are safer because they put some guidelines in there, it's still a risk, guys. It's still 100%. A risk. I think that's 100%. What we miss, right?
That's right. And again, the saving grace is, I think we have had a lot of responsible lenders that have, again, by and large, there's a lot less ARM exposure today than there was. And that is the main thing preventing us from a crisis right now.
That's very true, buddy. That's a big point right there.
Yep. So date responsibly.
All right, what do we got here? What is this awesome slide?
If there's some other stuff you want to check out, these are a couple of major papers out there. Oh,
you go back there.
A couple of really great papers out there. There's a lot of people have talked about lock-in. So lock-in's a little bit different than just raw rate. When we look at raw rate and we talk about those correlations, there's also a cliff function with lock-in, right? So it doesn't move in a line. And that's one of the things that's tough when you look at modeling is if it doesn't move in a line, then, it messes with correlations. Mm-hmm. Lock-in is really a cliff function, right? It's a function of how big of a difference is there between the rate that it's not what's my rate today versus what's the rate over here. It's the what is the rate I'm currently locked in at versus how much of a whammy would I take personally if I shift. And so that is easing a little bit. But there are a couple of pretty meaningful studies here, and I'll sum them up if you don't want to go read them. But this first one found that lock-in explained about 44% of the reduction in housing mobility, the tendency for people to move from one house to another.
Yeah.
That lock-in factor explained about 40% of the reduction in mobility from 2021 to 2022. So as rates rose, people were locked in. That was a big chunk. And then the second one really looked at the fact that, how much together did rates and lock-in restrict sales volume? And this isn't a 1-year period. This is a 1.5-year period. So make that adjustment. But it found that there were roughly 1.3 million fewer sales between 2022 Q2 and 2023 Q4 So over that 18-month period, about 1.3 million fewer sales than there would have been due to the combination of rates and lock-in.
I like that, man. Thank you for that. And by the way, everyone, if you want to just grab these, take a snapshot of them. And then what you could do is just upload it to ChatGPT, and then it can give you the live link from there. That way you don't have to type it in and be like, what was it? So it's a lot easier to do it that way. All right. And then explain to me this so we can wrap this piece up. How do you see Calque then fitting into the current world that we're stepping into?
Yeah, so our role is and has always been to try to facilitate what are really liquidity problems, right? The friction that comes when you're having to wait for an offer on the departing residence. And that's still our function, right? We're still here to help people move. And what we've done to try to make that work better in the environment where home sales have slowed is we've lengthened the time frame that we allow for someone to sell their house. So we make a guaranteed offer. The real estate agent has 6 months to sell that on the open market. If they don't sell the home in that time frame, we buy it at a discount. And yeah, it's a pretty hefty discount because we're not here to pay more for houses than they're going to be worth 6 months from now or a year from now, right?
Especially in a depreciating market, depending on where you're at.
That's exactly right. And so the way that we've tried to allow for that is twofold. One, our offers are going to be lower because we're not here to buy homes and flip them. We're here to give lenders the tools they need to make their investors feel confident in purchasing those mortgages so that your homeowner can go ahead and buy their next house. That's what we do. We're not an iBuyer. We don't plan to ever be an iBuyer. And so we've tried to solve for a slower market by providing more time. But in a declining market, the more time we provide means our offers have to be lower to adjust for it, right? And so some of that then is just us trying to make sure people understand the purpose of the program. If you have a really nasty house that you're looking for somebody to buy, let me recommend you talk to an iBuyer that advertises "We Buy Ugly Homes." If they say "We Buy Ugly Homes," sell them your ugly house. If you've got a clean, market-ready property that you can get your seller to price appropriately for the market, but it's not going to sell in a week, and you want to buy that next house in a month, and it may take a few months for you to do your job, that's what we're here to help with. And so check us out.
I feel like by the way, guys, if you have any questions about anything that Jeremy talked about or Calque, just put it into the chat while I ask my question and comment. I feel like what you guys do for us, forget the mortgage side of things for a second, real estate agents, right? I feel like what you can do for us is allow us to present better when it comes to a presentation to a listing on a listing side for a seller. I'm sitting there, I'm giving them options, right? And say, Mrs. Seller, I'm right here. This is what we normally do. But there's also another option. If you find this property that you love right now, here's this other option we've got. And this is what it looks like.
That's right. And typically, an agent can negotiate so much more aggressively with a non-contingent offer that you're usually going to end up saving more on the offer you need to make to win the residence you're negotiating on, to win the arriving residence. The amount of money you're typically going to save them is usually higher than the cost of our fee. And so that's pretty meaningful because you can provide that additional certainty, you can provide that additional convenience, you can provide that benefit of timing, and you can do all of it while also saving them money. And that's a pretty rare thing in this market.
I like it. Thanks, man. This was fun. You know what, Jeremy? We should, whenever we do these, we should do like the update from you, and then also incorporate how Calque fits into this, because we're in an ever-changing market, but I think Calque fits into all markets and maybe slightly differently depending on the market.
Yeah,
Yeah,
100%.
I love that. Let's definitely do that because you had me engaged. Like I want to know this stuff more, and you gave me a very good overview of everything. So thank you.
Yeah, absolutely. It was great visiting with you.
Thanks. And thanks everybody. Appreciate you all. Jeremy, take care of yourself. Everyone, please check out Calque, and that's how you spell it. You see Jeremy's name, or you can scan the QR code, but it's CALQUE.
Yep.
Thanks all.
Bye, everybody.